Welcome, everybody, to the ARMR Report. This is the Algorithmic Risk Management Research Report. Thank you for joining me. I'm your host, Brett Rosenthal. You're either, this is a live trading desk, by the way, so the phone's going to ring sometimes. Hey, I got back to you. All right, live trading desk, managing real capital every day, my own personal capital, that of individual investors as well. We're affiliated with Interactive Brokers. This is a show about investing in the stock market in the millennial age. What that means is we still have a high degree of respect for fundamental analysis. We do it every day. We're going to go over that in a minute. But we pair that traditional analysis with millennial execution tools, most importantly, the algorithm. We have our proprietary algorithms. I've been, in one way or another, building computer models and algorithms for 30 years. In the last 6 years, we've taken a lot of capital on our end to perfect that, and then we bring to you the ARMR Report so that you could become comfortable with the terms and understand how to execute using algorithms, and then, hop on our back if you want. We'll help you out. You can watch this show live streaming on YouTube. You can pick up the podcasts and use our website as a source to help you determine when to add risk and when to take risk off in your own investment approach. That's one way to do it. Just simply use the information flow from the desk. Look at your own portfolio and say, okay, if we're risk on here, here's what I want to add to. If it's time to take risk off, I raise whatever percentage of cash you want to raise to make you feel comfortable in a difficult market. That's what we're doing here. So step one in the show is always to look at the top 5 indexes that we follow: the S&P, the Dow, the NASDAQ 100, small cap index, mid cap, or not mid cap anymore. Momentum is more important. And so a quick review of those algorithms designed for the volatility of those particular assets reveals that we're 100% cash across the board. And if you go look at our website, we have a couple of sources for you. One is the real-time risk-on, risk-off monitor. So if anything changes with those 5 indexes and our algorithms, I let you know there first. I'll tell you on Twitter to take a peek, and I update that as soon as I can. Those of you who follow it would have saved you some serious money on Tuesday as we were going to cash in an aggressive way. But also, if you scroll right below that, rosenthalcapital.com is the website, you'll see the model portfolios we have set up at Interactive Brokers that an individual can link their account to. And I show you the conservative, balanced, and aggressive approaches and what that means to us. Conservative, balanced, and aggressive. I wish there were better titles I could come up with that would convey what we're doing, because conservative and balanced and aggressive really has so many, everyone has their own opinion of what that means. So what I'm trying to do on our website there is show you what it means in reality. I'm showing you what our portfolios look like. And so on a conservative portfolio, we're just carrying a whole bunch of cash and a small amount of an ETF position in a particular group that has a high dividend. And then in our aggressive approach, we're short the market. You see what I'm saying? In a balanced approach, we're not short, but maybe we have a little bit of a bigger position in some of these dividend payers. And of course, we always focus on the cannabis stock. It's the very top stocks. They're the very top of our list on the whiteboard of themes we want to invest in going forward. So we're always looking for opportunities there. All right, without further ado, let's get to those big indexes. Nothing has changed. I know the market had a big sell-off in the morning, rallied hard into the end of the day. No change to any of our algorithms. We're still cash across the board. Let me break it down for you, how we're going to address the market from here going forward until we get our next risk on entry point across the board. So What I'm about to say has a big caveat. If our algorithms tell us it's time to put risk on the long side, we'll do it. Until such that time, there's two things that we're doing in the portfolios, particularly the aggressive portfolio, less so balanced, and we're not doing this in conservative. But in aggressive portfolios, we're looking to short rallies. I haven't said that in a long time. I have not been a short seller in a long time. You know I like to get on the right side of probabilities and statistics. That's what I feel my job is, and what I'm trying to educate you on in this process is to get on the right side of probabilities and statistics. Don't make decisions when those probabilities are dramatically against you. So right out of the chute, if I'm saying to you I'm getting short, I'm already behind the probabilities, okay? 80% of the time the market goes up. So it's very hard to make money on the short side because the probabilities are usually against you. But I do have an important rule. You know, I'm building a list of rules for you guys on, rules of the road from investing over 30 years of doing this. And let's take a look, peruse the rules, try to figure out which one this is. Oh yeah, rule number 5 is my favorite. One of my favorites, rule number 5. You've got to determine your investing plan when the TV's off and the market's closed. And then execute that plan ruthlessly when the market is trading. Do not let market behavior throw you off your path on an intraday basis. You saw that story I tweeted out yesterday from CNBC that 80% of all activity on the exchanges intraday are algorithmic based. I've been saying that ad nauseum here since, this is my 51st episode. So I started back in August. Anybody who knows me, I built this whole website because algorithms dominate the market, because they so affect day trading, intermediate term investing, and long-term investing. The volatility gets so fierce, it throws long-term investors off. You can't let that happen to you. So the investing plan I have, I've got this written down in my book. I always follow this. I don't like to short the market, okay? I'm basically an optimistic guy. I think the markets usually go higher. We know that. But when the averages, the big averages are trading below the 200-day moving average, below the 50-day moving average, and the 50 and the 200 are in downtrends, that is the most dangerous time to own stocks, bar none. You can go back decades. That's proof. There could be a lot of volatility in an uptrend as long as you stay above those moving averages. That's just basic volatility. I don't like to get short in the middle of that. But once you break below, and we've tested it 3 times now on the S&P. Oh, I forgot. I promised you guys I'd do a screen capture yesterday, and I didn't get to it. Darn it. Okay, I'll do a screen capture today. And put it up on YouTube so you can see the S&P, you can see our algorithm overlaid on top of it, and you'll see this downtrend I'm talking about. But statistically speaking, the most amount of money made short is when the big indexes are below these moving averages and these moving averages are in downtrends. We've tested 3 times on the S&P to get back above that 200-day and the 50. We failed miserably this week. So to me, the window's open if you've got the stomach for it to put some money out short. I like to use index equity puts, limit my risk, but get paid if I'm right. There's nothing wrong with just holding cash, by the way. The market keeps going lower and you got cash. You own U.S. short-term treasuries with a better than 2% yield, and you wait out the decline, you've got your capital intact, ready to go to work on the next risk-on signal. Nothing wrong with that. And quite frankly, I suggest that for most people. But for my ultra aggressive portfolio and individuals, we'll go out there and we'll do some of these things on rallies. This morning's rally is a perfect example. Took, for instance, the Dow right up to its moving average. It reversed. We added that asset to our short side. We already had shorts on the S&P, the NASDAQ, and the small caps. Now we've got the Dow. I try on an intraday basis to get long now to hedge off that risk. So when the market sells off really hard, we're down over 1% on the S&P, 2% on the NASDAQ, the window opens for me to start putting money to work on the long side, but hasn't worked today. We had a quick trade at 11:33 on our algorithm on the Qs, and we were out. Let me take a look. At 11:51, booking a real quick profit, and the market made new lows. So the way the market's tracking right now, I don't see a new long position on at the moment. All right, so that's where we are in the indexes. Let's get to the fun part of the day, shall we? You guys who know me, who've been watching these videos and listening to my podcasts, know that the single most important investment theme, in my opinion, it's just my opinion now, in the next 1 to 3 to 5 years, is going to be the cannabis stocks. I've just been saying it. I've been saying it since August 15th, when Constellation Brands put $4 billion in Canopy. I said that was the watershed event. And I said to you, they will not be the only big player in this space. So we bought the asset, MJ, went up 50% in 5 weeks. And hey, man, we hit targets, we booked profits, we raised stops, we got out. These stocks got destroyed, came all the way back to $27 a share. I think it actually undercut that yesterday in the midst of the market sell-off. That was interesting. There's one stock in our portfolio. I'm sorry, there's two. We have two stocks. The biggest stock in our portfolio, a single stock, not a group ETF or an index. Our biggest equity position in our portfolios was Cronos, KRON. Let's give credit where it's due to old school fundamental analysis. Let's give credit. If you do the homework and you do the analysis, you can make money even in a horrific down market. So the market's imploding, and the only stock that we do not sell, well, that's not true. There's one other company we own. But the biggest position we have was in Cronos. And today we have the announcement that Altria put $1.8 billion into Cronos, giving them a war chest to execute. If you've been listening to me, if anybody is out there listening to me, I hope I helped you. I laid out for you why Cronos was the most important stock to have in the portfolio, probably second to Canopy. I mean, Canopy should be in there, but Cronos was important. And the reason was, I revealed to you, I was on the conference call, I listened to the earnings announcement, listened to the conference calls, and I came away with one important, probably the most important fact about Cronos versus all of its peers, these other small, kind of cannabis names. I said, look, the stocks we want to involve ourselves in the marijuana space going forward are the companies that are taking THC and taking CBD and turning it into value-added products. I don't want the big growers. I don't want the guys that are doing the extraction. I want guys with a war chest to build brand that are adding value so the average selling prices are going up. That's what we want. We want cannabis players that have intellectual property. That's why Constellation Brands put money into Canopy. And when I listened to the conference call for Cronos, I came away from that call, and you could do it too. This is not, okay, I've been doing this 30 years, so I'm used to this. When I lived in New York, built our business in New York, we used to meet with probably 3 or 4 different management teams of companies every week in our conference room, because everybody comes to New York every every major company, any company really, comes through New York at least once a year, especially when they're looking to raise money. So you get a chance to see a lot of management teams. And this was my education as I was growing up. My dad's an analyst on the street. He's been doing this more than 50 years, and kind of taught me all that I know in that area. So I'll grant you that I was able to glean from this conference call maybe more than you would if you haven't been doing this your whole life. But I tried to share this with you. And if you get on these conference calls and listen, you can pick up things. And the CEO of Cronos basically laid out the story that he's building a company around intellectual property, just like Constellation Brands. Just like Canopy. And he also said on the conference call, and I revealed this to you a couple podcasts ago, that they don't need to raise capital, they're going to partner. He said it right there on the conference call. It wasn't hard. It's the biggest position in our portfolios. Wasn't hard. Now the stock's up another 25%. Don't forget it was up big already. So now it's running. It's up another 25% because Altria decides to put in $1.8 billion. So I teased on my Twitter feed that I was going to reveal to you the number one most important fact that I have gleaned from all the conference calls I'm listening to in the cannabis space. It's one fact. And by the way, I sent you a link. Go to my Twitter feed, hashtag ARMR Report, ARMR Report, and click on the link for the TLRY third quarter conference call. They had this call a little while ago in November. But I find it's very good to go back and revisit conference calls, listen again. You hear different things. The stocks aren't moving and nobody cares about the conference call today. So I can kind of just listen to it and listen for things I may have missed in the midst of the hysteria when the earnings come out. And I told you on Twitter, I'm going to reveal to you, just like I revealed to you that Cronos was the right stock to own because of the IP focus they had. I'm going to reveal to you the most important fact that I've gathered from all the conference calls that I've listened to in the space. This fact makes these companies dangerous right now. I'll grant you that. But it also reveals the massive opportunity in investing in cannabis stocks. And here's the fact. You ready? Grab a pen, grab a piece of paper. You're going to write this down, and then you can do your own research in the ensuing quarters. Get on the calls and listen, do your own research. You can learn from this fact. There's nobody on the call. There's nobody there. TLRY is probably the highest profile US-based IPO in the cannabis space this year. There were 4 questions asked on the conference call. 4. You want to know who's covering the company? I'll tell you. Northland Securities. You ever heard of them? BMO Capital. I've heard of them, but BMO Capital? Ross Partners? And probably the most important was a Benchmark, which is a venture capital company. Those are the 4 guys asking questions. There's no Goldman, there's no Morgan, there's no anybody. The mainstream investing institutional class is not in this space yet. And the best way to make a lot of money over your life as an investor is to put capital into assets in front of a wave of institutional ownership. It's the best way to do it. Now, can it be dangerous at the beginning? Absolutely. Because it cuts both ways. These stocks are so under-owned that basically it's a retail base, and retail investors don't have a big stomach for swings, and they don't support stocks, and you know how it is. What puts stocks up sustainably over a long period of time in a nice 45-degree angle is when institutions decide that it's time to get exposure to a space. And right now, they're just not doing it. So you're going to get a lot of volatility in the space, which makes it dangerous. But at the same time, you've got businesses, multi-billion-dollar businesses, sinking billions of dollars into the cannabis space. How long do you think it's going to take before institutional investors decide to start building positions? So our job now is to figure out what are the best companies to own. I read a ridiculous and misguided investment piece on Motley Fool today about how the cannabis stocks are dramatically overvalued because they don't have any revenue or earnings yet. Let me tell you something. If you don't learn from past cycles, how are you ever going to be successful as an investor? That line of reasoning about cannabis companies is exactly the line of reasoning I heard from the exact type of people in the late 1990s about the internet stocks. Overvalued, no earnings. Are there going to be a couple blowups in the cannabis space? Absolutely. Remember that sock puppet selling, dog food? That company went bankrupt, right? The sock puppet selling dog food on the internet went bankrupt. So you can't own the wrong names, but you can own the Google, the Amazon, the Facebook. Yahoo was a huge success. The right names in front of institutional ownership is what builds your next fortune. So our job is to figure out what the right names are. I would say two things to focus on in that regard. One, the companies that already have a war chest so they can build brand. Just off the top of my head, TLRY, if you listen to the conference call, they've got $500 million of cash, and they access private markets all the time to raise it. Peter Thiel is one of their original investors. They're always going to have access to capital at the right price. Canopy, CGC, we know has $4 billion war chest, and now Cronos has $1.8 billion. And there will be others. MJ is the ETF that represents this whole group, and it's a great way to play it without the risk of the single stock idea. So, hope that helps you a little bit about the space. When you listen to conference call now going forward, listen to the question and answer session. It's probably the most important part of the call. The other stuff might bore you to death, the management comments, and then, the financials, and you get a little bit lost thinking to yourself, how do I figure out if these financials are any good? And you start coming up with valuations, which is ridiculous. Because at the beginning of an investment themed cycle, the valuation doesn't make any difference. Just look at Amazon if you want to argue that point with me. The company was losing money forever and the stock was going through the roof. So don't tell me that valuations at the beginning of an investment cycle mean that much. They don't. They don't. What matters is intellectual property, high barriers to entry in the business, and a war chest to build brand. We're at that stage, and you need to find the right names. I tried to hand you Cronos. I gave you a handoff there, and I told you why, and you can see I was right. Altria made the investment. Now we got to keep digging for other names. So in the midst of all of this market selling, so here I am short the indexes, but long Cronos, I'm also going to share with you that I'm long right now. This is just to wrap up our research section of this podcast live stream. I'm just going to revisit for you the pipeline stocks. They keep bouncing around between $9.50. Actually, they got down to $9.30 the other day, up to $9.70. Gosh, it's an 11% yield, guys. And don't forget, I think that one reason we're here is that the price of oil has been overly depressed and the price of natural gas overly accelerated higher because of a hedge fund trap that had to be unwound. So when that's finally over, prices should stabilize. And I'm not looking for a huge move higher in AMLP, which is the ETF of choice, AMLP. But geez, if that stock just goes back above 10 and pays me a 10%, or actually after cost, it's more than a 10% yield, I'm not going to end up holding that for a long time, collecting a serious income. It's just something to look at. Keep your eye on that. All right, so I'm going to split now. I'm going to end this a little bit early because I think what I'll do is then throughout the rest of the day, I'm going to put together a podcast for you, or a screen capture for you on YouTube to show you the S&P and where we are and why I'm willing to get short here, and where, the basic area where I would change that opinion, right? And of course, I would always change that opinion if our algorithms say it's time to get long. I'll go out there and get long. I may even stay short. I might stay long the puts and get long the asset, and just have a hedged position. Because for now, until the market really proves itself, I am at a reduced position. Even if we get long, the next time we get a long signal, I'll be doing the smallest exposure I would do. Even in my aggressive accounts, I'll get long and follow the algorithm, but the markets are in such a dangerous position right now that it calls for the most amount of risk management that we've had to face probably since, 2015. It's really dangerous right now. So do what you have to do to protect yourself. I still have these cannabis stocks at the top of my list. It doesn't mean that I won't stop a loss. So I only have Cronos in the account right now, and I have a small position in the ETF MJ. And I'll sell that MJ position if it takes out my stop. Okay, I'll go back to cash and wait for lower prices. So I hope today has helped you a bit. Those of you who are with me on Cronos, congratulations. It was a nice little run here. I still am long the stock. I think it's a big winner. I think it'll continue to go higher unless this whole market implodes, in which case, again, it'll hit a raise stop and I'll book a profit and wait for the next opportunity. Have a safe day out there. Have a good day of trading. Today's Friday, so have a great weekend, and I look forward to talking to you all again on Monday. Take care. And thanks for listening.